Hey, welcome to The Explainer. So today, we're going to tackle a big one. What does it really mean to have your investments managed by a professional? We're going to look at the process, the strategy, and yeah, even the psychology behind building a serious portfolio.
All right, let's kick things off with a scenario that, hopefully, a lot of us will face at some point. You've been working hard, you've been saving diligently, and now you're looking at a pretty nice nest egg. The big question hits you. So what's next? What's the smart play here?
It really boils down to two fundamental choices, right? On one hand, you've got consumption. You can take that money and enjoy the fruits of your labor right now. On the other hand, you've got investing, the idea of putting that money to work so that hopefully you have even more down the road.
Okay, so let's say you go with investing. You're basically making a deal with the future. You're putting off that big purchase, and you're taking on some amount of risk. In return, you expect something back. That something is what we call your required rate of return. You can just think of it as the minimum payback that makes delaying all that fun worth it.
So, how do you navigate all this? Well, a lot of folks turn to a professional guide to help them on this journey. And we're going to break down their entire process into 4 key stages. First, we'll meet your guide. Then, we'll create the blueprint. After that, we'll look at the toolkit. And finally, we'll talk about sticking it out for the long haul.
All right, let's jump into part 1, finding your guide. In the world of finance, this person is your portfolio manager, or PM for short. They're the specialists who build and manage investment portfolios for a living.
Now, the first thing you need to know about these services, often called PMS or portfolio management services, is that there's a barrier to entry. In India, the regulator SEBI has set the minimum investment at 50 lakh rupees. This really makes sure that the service is designed for serious, high-net-worth investors.
So you might be thinking, wait, how is this different from just buying a mutual fund? Well, if you look here, the key word is customization. A mutual fund is kind of like an off-the-rack suit. It fits a lot of people pretty well. A PMS, though, that's your bespoke, tailor-made suit. It's built just for you, usually with a smaller, more focused set of investments. And then you have AIFs, or alternative investment funds, which are even more specialized, typically starting at 1 crore.
Okay, so you've got your guide. Now it's time for the really important part, drawing up the map for your financial journey. This is the blueprint phase, and it's 100% about you. Before anyone even thinks about investing a single rupee, your manager needs to understand your number one goal. Are you all about capital preservation? Basically, building a fortress to protect what you have at all costs? Or are you aiming for capital appreciation, strapping in for a rocket launch, taking on more risk for potentially way bigger rewards? It's that classic tortoise versus the hare decision. And all of this gets sorted out during the onboarding process, which is laid out right here. Seriously, it's a deep dive. They get to know your goals, they figure out your actual tolerance for risk, not just what you say it is, and they lock in your time horizon. And all of that information funnels into the final and most crucial step, deciding your asset allocation. And I really want to pause on this for a moment, because this is probably the single most important idea in this whole explainer. Study after study has shown that over 90%, 90%, of how your portfolio performs comes down to this one decision. It's not about finding the next hot stock. It's about getting this big picture mix of assets right from the very beginning.
All right, our blueprint is locked in. So for part 3, let's peek inside the toolkit. How does a professional manager actually go about picking the specific things to put in your portfolio?
So how do the pros actually hunt for good investments? Well, most of them use what's called a top-down approach. Think of it like a giant funnel. They don't just start by chasing some hot stock tip. Nope. They start way up high with a huge 30,000-foot view of the entire economy. You know, what's going on with interest rates, with inflation, with overall growth. Okay, once they've got that big picture sorted, the funnel starts to get narrower. They go from the whole economy down to specific industries. They're asking, okay, based on everything happening right now, which sectors are set up to win? For example, if inflation is running high, maybe companies that sell essentials are a smarter bet than luxury goods companies.
And only then, right at the very bottom of that funnel, do they finally start digging into individual companies. Now the hunt is on for the absolute best in class, the crown jewels, the strongest businesses within those promising industries.
And the entire goal of all this hard work, all this analysis, is to figure out one thing, a company's intrinsic value. And you've got to understand, this is not the same as the stock price flashing on your screen. Not at all. It's an educated guess, a deep estimate of what the business itself is actually worth based on its fundamentals and what it's likely to earn in the future. You know, there's this great quote that just nails this idea perfectly. Price is a fact, but value is an opinion. Think about that. The price? That's just the number on the screen. It's a fact. But the value? That's where the skill comes in. That's a carefully formed opinion based on all that research. And a pro's entire job is to find those gaps where their opinion of value is way higher than the market's price.
Okay, we've met our guide, we've drawn the map, we've seen the tools, but the journey's just getting started. This brings us to part 4, the long haul. This is all about navigating the road ahead, with all its inevitable twists and turns. You see, a portfolio manager's job doesn't just stop once they've bought the investments. It's a constant cycle. They're always monitoring performance, they're rebalancing things to make sure you're still on track with your original plan, and of course, they are managing risk when the market gets bumpy. But maybe one of the biggest, and I mean biggest, things a manager does has nothing to do with numbers. It's psychological. They're your defense against your own brain doing silly things. Take something called status quo bias. It's that powerful little voice in your head that says, just leave it. Don't change anything, even when you know you probably should. A good manager provides the discipline to make that unemotional, rational call.
So, when you boil it all down, what's this all about? It's about swapping gut feelings and all that market chatter for a clear, disciplined, professional plan. And that really leaves you with one big question to ask yourself about your own money. Is your portfolio built on a solid, professional plan, or is it just getting pushed around by all the day-to-day noise?